let's study section 1. We're going to look at ledgers and other subsidiary books in accounting system. These are the outcomes. Then outcomes. We're going to learn the introduction. We look at accounting is the process of recording, which we said before, summarizing, analyzing, and reporting financial transactions of the business for users' decision making. Measurably, we know that this is what accounting is. The purpose, the general endpoint or purpose of accounting is to classify this information, to move this information for users to use it in making decisions. The learning outcome, we see that we're going to study the uses of different types of accounts. The uses of different types of ledger, discuss purchases, return invoice, and return accruals books. We're going to explain bad debts, provision for bad debt. We're going to look at work access tasks, sales invoices, and suspense accounts. We have some definitions. General ledger. This is used to record the remaining double entry accounts, such as those relating to expenses, non-current and fixed assets, and capital. We have return invoice, which is sometimes called sales returns. These are sales returns from customers. That's when customer buys something from you and they find out that this is not good, this is not what they want, they return it back to you. It's called sales return or return invoice. We have return artworks. Can we also call it purchases return? These are goods returned to suppliers. Who returns this one? The organization, the entity, return these goods back to the supplier. We have bad debt. What is bad debt? Bad debts are debt that cannot be recovered again. A bad debt, the organization will not be able to recover. So that's why we call it bad. So once it's bad, it's an irrecoverable debt, which will be a loss to the organization, and you write it off through profit or loss account. We have provision for bad debt. What is provision for bad debt? Provision for bad debt is also referred as provision for bad debt or provision for losses or provision for that for debt. These are provisions you make in case if a bad debt will occur. Now, reasons for making provision for bad debt. Why do we make provision for bad debt? One of the reasons is that provisions help to show the true figure of debtors to be reflected in the statement of financial position. We call balance sheet. Remember, balance sheet, the name balance sheet has been changed, though we are going to be using it interchangeably. The name now is statement of financial position according to the standard. The next reason for making provision for bad debt, provisions are made to help cushion the effect of default by debtors. That's one of the reasons. Another reason is making such provision is in line with the prudent concept. When you make provision for bad debt, it's in line with prudent concept. You're trying to be prudent so that you capture every necessary thing you need to do. Making adequate provision will prevent profit or loss account from being overstated. Once you make the right provision, the appropriate provision to make this your P&L account to not to be what? Overstated. That's one of the reasons for making provision for bad debt. Then the last not the least reason that it helps to ensure that revenue is matched with expenses in line with matching concept. That matching concept means that the revenue earned in this period should be matched with the expenses incurred in this period to ascertain whether you make profit or not.